Hi, Jonathan. How's it
Good
going?
morning. Can you hear me? Or good evening? Yep.
I can. Can you?
Yeah, yeah, it's good. Yep.
Okay, good.
Uh,
I also invited a young colleague of mine that I just recruited somehow. He finished his PhD Riemannian geometry, zeta
right.
functions and things, but he wants to do a bit on the side. So but I kind of told him very, very late, which is like 15 minutes ago. So probably from next week.
Oh,
Uh,
well, that's fine. I mean, I'll wait a few minutes. I've got a number of slides, but I'm just sort of I'm trying to monitor everything here. I've got the chat window from the YouTube, and I've got this chat window up, so I think we can wait a couple of minutes.
yeah.
Uh, yeah, they're joking. On my Facebook thread, they're joking. Well, so the physics prize was on AI, the chemistry prize is on AI. It said maybe the literature prize should also be on AI. I mean, you can still have the economics prize on Monday be on AI. So, but it's interesting. I just
Yeah,
went,
it looks like some, yeah. I I don't know about the merit of the price itself, but certainly AI is I mean, is the great revolution.
right,
This and it's also true that lately the Nobel committee seems to
right.
want to be on various bandwagons. So, uh,
Yeah, they're mysterious. I think.
I mean, they want to be relevant somehow. It
Yeah,
was
well,
unusual when Obama got the Nobel Peace
right,
Prize, for example, or well, even when Bob Dylan got it. I mean, it was
right,
like,
right.
okay,
It's
are you trying to convert new people to the Nobel thing? Or yeah. So AI, it's a good choice, but probably there is a big merit from behind all this. I'm just simply not
yeah, yeah. I don't
knowledgeable
understand
enough.
it that well. I think it's more like what you said. I think I might have said last week the that there was a German guy at a recent AI conference or model risk management conference, and he spoke about AI. Said it's sort of like early 20th century physics, people trying to understand, Planck and Einstein and Schrödinger and Heisenberg, and like, what does this all mean? How can this be connected to reality? And then 100 years later, it's dogma. It's the thing that you're basing. Well, I think it was Hinton of the two physics guys said that he felt AI was like a another industrial revolution.
Yes, it looks like it.
Yeah,
So well, we'll see how long it will
right.
last. I mean, no, it will be there, but I mean, maybe now at the beginning it's even more, accelerated, but then, it
Yeah,
will.
it's more of a fashion. Yeah. The
Mm.
Right. Well, I still have the idea of the three flavors, just to put that out there and put it on the archive yet again. That you can, number one, you can try to convert your conventional price and risking models into AI ones or enhance them. Number two, you can use AI as a bot, particularly for model governance and model risk management. I think that's probably the most robust one. To me, it's the equivalent of, instead of just having a check engine light as being binomial, your engine is bad, you're and instead producing these digital codes. So that's kind of a little maybe AI, or at least a little technology. And then the third one is just how the regulators think of it. Um, and so the conference I went to the last couple of days was on AI in financial services here in the city. And I was listening more for the regulators. There were two New York Fed guys who spoke. And one of them said, well, I'm one of the authors of SR 11.7, and this is how I'm trying to see how this works. The second guy made a distinction between an AI model, and again, model being a loaded word, we know, but uh, putting that aside, he said, well, some of these aren't models there. And then he said, they're approaches. which sort of gets into a narrative that I'm looking at because, like, first of all, if you call LLM a model, well, you're not really going to be validating LLM as a model. I think you're going to be embedding it in something else. So it sort of gets to the point of, we don't validate that the square root algorithm works, but that's almost like what you have to do if so. All right, so I think I see Greg Marps jumped on, so that's good. Yeah, let's run it right to 9:05 New York. So that's about 2 minutes.
Thanks, John.
Yeah. What's scary is that some of these Nobel laureates, like I'm reading about David Baker, one of the Chem Nobels, he was at Berkeley when I was at Berkeley, and we were both doing our PhDs at the same time. He finished a year earlier, so he was even ahead of me then. So, but seems like a very smart guy.
So you are still waiting for yours.
Exactly. Yeah.
Yeah.
I'd go for economics. I read a little poetry, literature, physics, maybe all three. Yeah.
Yeah. Math doesn't have one. So
I know math. Yeah. That's the problem. Well, that's why the AI award, my mathematician friends are saying the physics award was really for a mathematical technique or the use of a math. So
yes, there are all sorts of legends about why there is not a
right. No, what Nobel's
personal.
Nobel's wife was having an affair with a mathematician. Yeah. I thought
Yeah.
it used to be the Fields Medal, but someone said that something replaced that in math, that they do have something more like an annual. It's been a few years, but
Yeah, they have the Abel Prize.
the album, yeah.
Yeah. The Fields is given up to, you need to be 40 before, you need to get it before you are 40.
Yeah, there's a cap, yeah.
And then, so it's a sort of a bet too on somebody's performance. While Nobel is kind of leave it to your grandkids stuff.
Right.
So, yeah, so Abel is more on that.
Okay.
It's quite interesting, yeah. It doesn't get the same publicity, but it's interesting. I think Atiah got one in the first year. Yeah, very, yeah.
I'm going to share.
It's very difficult to get.
I'm going to share my PowerPoint here. I'm trying to do this so I can, no, I can't see the Zoom text window. At least I can see the YouTube window. All right. Okay. Trying to multiplex. Okay. So good morning. I think you guys can both see my screen. It's, I guess I'll just do the slideshow thing. That's nicer. It's bigger. Okay. So, I think I called this a couple different things, but my idea is that, yeah, what can we teach to a junior FE, the moment that they get the model to see something that maybe not necessarily a red flag, but something that, they might pick up that might guide the way that they might do the model. And also, as described in some of the later sections in this talk, maybe what's missing, what they might need to request from the model developer so that they can do a good and complete validation job. You guys have been through this before, but just to put this up and have it long enough on the archive so people can read it, this is a continuation of my discussions that are related to our upcoming model risk management textbook, academic press, forthcoming in 2026. So we take some of the ideas from the book and present them here, and we take some of the ideas that we discuss here and put them in the book. There are 5 sections to this talk. The first are the somewhat familiar tests, most of them, I think, that you would do so right off the bat. The second drills a little bit into more of the practicalities, and so therefore, what sort of approaches you take and what sort of frame of mind you have. And this may be targeted to a validator who's presented with a whole bunch of different types of instruments and has that. I see that I can't pronounce your first name, but I guess it's Mr. Stan. I think you're Radu's friend, so thanks for jumping on.
Yes, yes.
Thank you.
Hello.
So knowing your instrument then implies in section 3 that you may need to have more information. For example, are there callable features in the structure? They need to be spelled out. That then may depend on those schedules, like a call schedule, or in the case of an amortizing or sinking fund situation, not just the schedule of the dates that the sinks will occur, but also the amounts of principal that is sunk. I can go into that more. And then at the end, not last, but definitely not least, we'll talk about the types of things that MRM looks for, directly driven by things like SR 11.7. I'm just going to put this up for a couple of seconds, but since Radu mentioned Bob Dylan as a Nobel laureate, so I use this slide to just remind people that Europe and the US change about a week apart as far as their time change. So this will not affect next week. It will affect, I guess, the last Wednesday in October. There'll be 4 hours between New York and London and not 5, and so on for the rest of Europe. Okay, so yeah, among quant checks will be things like parity checks and particulars of each instrument, what one should be looking for. So options, very common in optionality. So if you're just given things like calls and puts, or equivalently an implied volatility surface, then there are some checks that can be done. Let's see, I can never position this thing so I can, okay, this is better. All right, so essentially what the slide says is that the strike price and time dimensions of an option price, under the assumption of no dividends, can be studied by looking at their first and second derivatives. So specifically, that means here the first derivative of the price, the call or the put, with respect to strike, not underlying, the second derivative thereof, and the first derivative, first partial with respect to time to maturity. Let's see. No. Okay. Oh, skip one. It didn't respond. All right, let me just make sure. Yeah, okay. There's a slide number. I'll go by that. So one of the ways you can think about this, usually we would span a price, a price, let's say, of a call option for a small interval in the underlying, let's say. So that goes to then these would be the delta and the gamma in a Taylor expansion. In this case, again, we're expanding in strike. So that's where you have the first and second partials. And the first derivative, partial C with respect to K, is intuitive, right? For a call, for anything, an out-of-the-money call is less valuable than an at-the-money call. And I'm calling that the strike slope. It's the opposite sign for a put because, as it says at the bottom, a higher strike is further into the money, but it still preserves the idea that an out-of-the-money put is less than an out-of-the-money call. An out-of-the-money put is less than an at-the-money put. Numerically, we could do them by finite differences like this. And so this is, again, emphasizing, this point here, the higher K is further into the money. Now, the second derivative is important as well. And here, just a little bit of math. So calls and puts are convex, which means that a call on the left-hand side can be more or less represented by a convex combination. That means that lambda is on 0, 1, and this is, let's say, 2 nearby points. So sometimes this is done in saying that here's a central strike, and these are the 2 strikes on either side by a small amount different. or it could be K1, K2, K3. Anyway, so by convexity, this combination will always be at least as much as the call price. So we just say, okay, then let's take lambda equals 1/2 and, rearrange things. So that means that the price of the call that's slightly out of the money plus the one that's slightly in the money relative to the at the money call obeys this. So the test is, so this is basically a butterfly, right? A butterfly would be 2 long calls and 1 short call. And this also holds for puts. The same sign is true for puts. To show that that's the second derivative, we can show that numerically. We just rearrange this, and then this is the partial of the difference between the 2 first derivatives, right? So the practical application of this, of course, is just if you have a grid of calls and puts with respect to strike, that you can look for these possible arbitrages so that the strike slope has the wrong value. So that might be a sign of bad data. It might be a number of things. I mean, there are transaction costs and some other things. But in theory, the first partial of call is negative, put is positive, and for both of them, the second derivatives are positive. The other dimension, of course, is time. And here, this is intuitive, that price is an increasing function of t. The longer time that you have to expiration, the more the optionality is worth, because you had more of a chance of it eventually being closing at the money or above. So a 2-month option is worth more than a 1-month option. That's, again, something easy to check and should be done. Okay, another arbitrage, which is it's also an arbitrage, and it also can be seen in options or even in cash, is comes from another math property, and that's associativity. Essentially, that currency rates obey a triangle arbitrage because they're simply ratios. So if we have any 2 currencies, I'm denoting the FX rate between the 2 as this A to B. So this could be the traded currency and the base currency. So then, it's easy to see that by associativity of multiplication and division, you can do this. So that implies that, for example, if I observe cable, the USD sterling rate, and if I observe the USD euro rate, then I should be able to tie out to the euro sterling rate. So that's a good check. Also note that since we are speaking about FX, that the convexity and the slope checks I said before are done slightly differently, maybe a little bit more formally. FX usually speaks in terms of delta and not K. Delta, you remember, is the risk neutral exercise probability, essentially. Delta is expressed as a number between 1 and 100, meaning the percentage. So 50 delta is, 0.5. And it's the most liquid things then are the 25 call and the 25 put. So these are, these are out of the money on either side, and they tend to be very liquid. You can also use the 5 delta and 10 delta, but that's less common. Maybe 15 delta. Anyway, so all that means, I'm just drawing the analogy here, is that when we talk about the slope, that would be something like long the call and short the put. The equivalent of that is what's looked at, and that's called a risk reversal. So it's a sort of a measure of asymmetry. Whereas the butterfly is now long the 25 call and the 25 put, but short the 2 at the monies. Another very rich topic is parity, arbitrage first, parity second. And this relies on, strictly for European options, that the difference between the call and the price, the call and the put prices, is related to the underlying and the strike price and the rate. So this is something that easily could be checked, the underlying and so on. And it's fairly common. It's also easy to prove this, done in a lot of elementary textbooks, by constructing the replicating portfolio. This essentially is the portfolio that replicates this difference. How does that look in fixed income? Well, in this case, we can first talk about swaption parity, and then we can talk about floor cap floor parity. So just to remind you, a receiver option receives fixed and is like a call, and a payer option is pays fixed. Both of these in some swap. And we're going to consider in this case that the swap is fixed rate is K and these two are struck at K. If that's the case, then there is parity. The receiver option is the difference between the two is equivalent to the PV of the swap if parity holds. And and correspondingly for a cap and a floor, well, in this case, we're just capping floating rates. But in parity, so this part of the floating rate then has to be equivalent to the fixed leg payments for a swap. In this case, you could think of a cap as a floor and a put as a call. Of course, in all of these things, you want to make sure that you can compute the swap rate from a swap that's given to you in a model, and that setting PV equal to 0, it will tie out to market swap rates. And then just to say a little bit more about volatility surfaces. So in fixed income, you can have a surface meaning 2 dimensions. Those would be strike and expiry. Whereas it's 3-dimensional, sometimes called a cube for swaptions. So then you have swaption expiry, but also that's exercised into a swap, right? So this may be familiar to most of you, but a swaption is stated as being its swaption expiry times the swap tenor. Like a 1/10 is a 1-year option into a 10-year swap. And for calibration, things like calibrating Hull White, you calibrate with swaptions, you look at a diagonal set, which is kind of like a family. In this case, the expiry plus the tenor sum to 11. So it's 1/10, 2/9, and so on. It's a diagonal of the table where, let's say, the rows are the expiries and the columns are the swap tenors. So we discussed first arbitrage bounds and then parity. The other thing to do when you're looking at the model the first time is see if you can reduce it to a simpler form. So you're given a Bermudan swaption. So how about just using it to price a European swaption, which you could do, for example, in Black 76. With an Asian option, you can think about, let me just move this out of my field of view. With an Asian option, you can think about just removing the averaging, just having, again, a European option. The various legs of a swap, as we've seen, can be decomposed into other interest rate instruments, and so on and so forth, removing the credit spread in a credit-sensitive vehicle. Okay, so now it's a little bit like, you say, know your customer. So here, let's just do a refresh for some maybe, but also for just to codify. I have read a lot of papers, especially from model development, model review, where there's a bit of confusion on common things. The first one being stock options. So a listed stock option means an option on an individual stock like Google, and an index option is, well, more like on the S&P 500 or the FTSE or something. So there are some key differences between these two. Let's just point them out. They generally both are of the order of 2 to 3 months, most liquid. And but here the differences begin. So individual stock options are American style exercise, and that's because they have lumpy dividends. And I'll emphasize again what happens when a stock pays a dividend and what happens to the option. But it needs to be American because you need to be able to decide whether you want to hold the stock even through the time that the dividend is paid. There's also an important point, which is that, and this is basic to things like Black-Scholes, that they are physically settled. In other words, a call option, if it's exercised, you receive the stock. You don't receive cash. And on the basis of that, you can construct a replicating portfolio if short sales are allowed to any vanilla call or put. In the case of an index, there's some key differences. First is European style exercise. And the way the index is packaged, there are no lumpy dividends. What S&P will do is they'll collect all the dividends paid out in a particular quarter, and then we'll express that as a dividend yield. So that's like continuous dividends, or appears to be. It's re-expressed in that way. And second, they're cash settled. So anyone who thinks you can do, you can do a long short position, a long short options in with a single stock, and on either end you could hedge with the stock. On it, the same thing really doesn't make sense with an index option because either leg has to be paid in cash. So that unless you think about a hedge position being a bank account, the money market account, it's not really a hedge. And you may have to pay all of the short position. It's not really offset by the long position. All right, a little bit about bond pricing as well. That's something that I started off in. And something that, if someone gives you a bond model, you have to ask questions. For example, is it a high grade bond? In which case we're essentially.
Jonathan, can I ask a quick one?
Yes, sorry. Yep.
So if you were delta hedging an index option, could you use an index future?
Could you use an index future? Yeah, I mean the most common use of futures is to hedge the actual index, not the index option, or to hedge a portfolio, which has some sort of beta to the index.
I wonder how a dealer would hedge an index option that they sell to.
Yeah,
they must use a.
I think it would be a bit of whoops. I think it'd be a bit of an accounting difficulty, or it would be difficult because you need the margin account. All those things have to be done in the margin account. So you're doing daily margin, variational margining on the future and on the call. So I think that's why it's easier to hedge with something that isn't margin per se. But that's my first impression. In theory, you should be able to hedge it with futures, but again, it's basically cash hedging cash because the future exercises into the future is cash settled as well. Yeah. You could ask, could single stock futures be used to hedge a call on a single stock? But I haven't really seen the single stock futures. I don't exist. And Greg, I think there's some background noise, so when you sorry. Okay. All right. So basically just, not to spend too much time on this, but high yield is closer to risky pricing. High grade is risk neutral pricing. So even the quotes are different, right? High grade is spread typically to a treasury, like a GM bond could be spread to the 5-year US Treasury yield if it itself is 5-year. And then you can calculate a yield to maturity by backing that out. It's like Newton-Raphson or something from the market price, and some sort of assumption of coupon reinvestment rates. On the other hand, the high yield is quoted like cents on a dollar, so 85 cents or par 100. Another thing to note is that to make things more confusing, bonds are issued at 1,000, typically sometimes 10,000 or more. So when I say 85 for a high yield bond, that means it's $850. face. Also notice that whatever you get from a model may be either a clean or a dirty price. It's important to get that. Remember, with stocks, as I'll talk about a little bit more, you either get the dividend or you don't. Whereas with a bond, you get a partial share of the coupon unless you're doing your transaction on a coupon payment date. So you essentially get, the period of time that you own it over the total coupon period, which might be 6 months or a year. So that's the clean prices without the last coupon payment. The dirty price adds that back in, and that's what the market will pay. Let's go a little bit more into swaps. We've mainly been talking about vanilla swaps. This is kind of a laundry list. I think the key ones on this are when there is optionality, for example, a forward start or a cancelable. Constant maturity swaps are maybe outside the scope of this, but these days I think they'd largely be constant maturity treasury, because without LIBOR, there's not really anything like a constant maturity swap rate. But you can do it from CMTs. And then compounding. Compounding is important because we need to talk a little bit about SOFR. So in constructing swaps, like when I was growing up, or when I was new to the market in the early 2000s, there was LIBOR. And so a 3-month loan, you'd look up the 3-month LIBOR rate and do that. You could have a 3-month LIBOR on the floating leg of a swap. It would be very clear. But we got rid of LIBOR, right? And we replaced it with overnight SOFR, which is, again, it's an overnight rate. That's the O in SOFR, but I call it O SOFR. And that gets things complicated when we're doing periodic payments. For one thing, this was the rate for a future payment, a term rate. So what the rate will be in 3 months. And that's because the British Bankers Association and the banks that contributed it had infinite foresight and knew exactly what was going to happen in 3 and 6 months. But, OSOFR is definitely looking backwards. It's just last night's rate. So that's made for a little difficulty, among others, with that. First of all, a SOFR swap. So a LIBOR swap was, let's say, 3-month term LIBOR against 6-month, fixed. But you can't do that anymore on the float leg. You can certainly have that. They're now paid annually on the fixed side, but the receiver pays a compounded rate, which is at the end of the year, the compounding of O SOFR every day. So that's how the swap is. The payments are settled. So of course, then that gets an interesting model of, how are you modeling that? What if you're partway through the period, blah, blah, blah. And so there's been some interesting interest rate studies done on that. Also to note a little bit about another market instrument, which is the SOFR future, and that's maybe even more confusing. The Fed, the New York Fed specifically came out with SOFR and then had the issue of, well, how do we make 3-month, 1 month other rates out of it? So at the beginning, they tried 2 different things. They said, well, for 1 month, we could do averaging over the business days, looking 1 month back, or we could do compounding. CME, which started trading these futures, took those, and those definitions then got locked in. So today there are differences. So those differences persist. So the 3-month future on the CME is 3-month daily compounding of overnight SOFR, but the 1 month is still using the arithmetic mean or averaging. All right. So you don't have to ask why they're different. I just told you. It's history. Now, there is such a thing as term SOFR, but it's a little complicated. First of all, banks and sell side are fine doing this compounding. They know how to compound. I think end users, lenders, Loan IQ, the rest of them. Someone told me something startling one time. I think actually, Greg, you might verify this maybe later in the comment. But the loan system like Loan IQ, there's one thing that they can't do, and that's compound interest. Now that's really scary if a loan system doesn't know how to do overnight compounding. But apparently that's just not something that lenders do. They want to just look at a rate like LIBOR 3 months and say that's the rate. Of course, banks have no problem doing compounding. I mean, it's just, it's essentially just geometric averaging. But, so like all the traded instruments that are out there, the swaps and futures I mentioned, and everything else in SOFR is using overnight SOFR. It may be compounded for a period, but the base is overnight SOFR. Indeed, the base of term SOFR, which would be, the forward 1, 3, 6, and 12 months in this case from CME, is also overnight SOFR. Okay. So that there was a Fed paper, FRB, not New York Fed, that came out some years ago, which said if there was such a thing as 1 month and 3 month observable futures, then you could back into a term rate. And since futures exist out to 1.5 years or something, so that's how they can do 1, 3, 6, and 12. It's what the term rate might have been. But banks don't want to touch this term rate. In fact, they're told that they can't. And the reason is what's called sometimes the inverse pyramid, which is that SOFR is the rate. SOFR is how it should be compounded and used. If everyone started using term SOFR, which depends on overnight SOFR, then no one would be using overnight SOFR, in which case overnight SOFR would be illiquid, and then term SOFR would be meaningless. So at the moment, we have this thing where we have the two different kinds of SOFR. And, like I said, the lender may want 1 month or 3 month, but you can do that, but you won't be able to hedge it. I can go a little bit more into that the lender or whoever's using 2 SOFR is carrying a basis risk. They're carrying the risk between term SOFR, which is unhedgeable, and SOFR, which is easily hedgeable, right? The other aspect, since it only went out to 1 year, well, the SOFR swaps that I described are just not very liquid these days. They certainly have never traded on exchanges, but something like ICE is trying to, I think already does list some of them. So in a sense, like a swap execution facility, a SEF, based on Dodd-Frank. And certainly T-SOFR is easier to understand. Some would say, oh, well, that's really just turning SOFR into LIBOR. Well, not exactly, because I didn't define SOFR for you, but it's based on tri-party repo. And so therefore they're collateralized loans, and the collateral is treasuries. So SOFR is a secured rate, and the S in SOFR means secured. LIBOR was unsecured, it was whatever it was. So in addition to the basis between, so what the lenders really want is they want term SOFR plus something else reflecting this, they call it a credit risk, but it's more like the basis between SOFR and Fed funds, right? There's also that, let's say, LIBOR 3 month and 3 month Fed fund. Well, there is no such a thing, but any 3 month that was developer Fed funds would have a credit difference, because in one case, the lender is seen as, the borrower is seen as someone in the market, whereas here it's the US Treasury, full faith and credit. So it's a bit messy going from term SOFR back to and using it practically. Okay, just a little bit now on embedded calls, because if you haven't been in the bond market, you may not have seen this that much. The main thing about it, an embedded option, is that it doesn't trade freely. So therefore, it's essentially unobservable volatilities, implied vols. But they are relatively common. There are US Treasuries that are callable. Often they'll give you so-called call protection. So if it's a 10-year maturity, you have 5 years where it's non-call, right? Within that, they can be exercisable once, European style or Bermudan, and almost always on coupon dates. So a callable bond is a little bit like the issuer has sold a call to you, but also the stock. So you can, from the issuer standpoint, this is a hedge against rising rates, and they would falling rates, in the sense that they would want to go and issue at a lower rate if rates fall. That's actually a problem. Well, from the standpoint of the bondholder, a bond that's callable has to be cheaper because you may not be getting the whole maturity. And I'll talk a bit about option adjusted spread and measure how expensive the option is. As I said, it doesn't trade freely, so you can't just go to the market and say, how much is a treasury call option, right? At least for corporates. I think there are some treasury options that trade, but in the corporate and outside US Treasury, they don't. But there's also a kind of negative convexity in these covered calls. Same type of thing shows up in some mortgage products that you, the bondholder, have just had your bond called away because rates are low. You were getting a good coupon rate. But again, the reason that it was called is because rates got low. And so now you need to reinvest. But now any other product you would look into is also low. So that's negative convexity. It's like the prepayment option in mortgages. Right. I've already said the bond option can't be separated, that this is unobservable. One of the things that people look at is interest rate swaption vols. But we don't really know the implied vol of those call options. We can't just look it up in the market every day. And then just to say what the option adjusted spread is, this is basically the key takeaway here, that in an interest rate tree, the discount factor would be 1 plus the short rate. But there's an additional spread that's added on to that to reflect the fact that there's optionality. So for example, you can use a binomial tree here. What vols do you use? Well, you have to use swaption vols, so that's somewhat inexact. And the call option schedule, which I'll tell you in a minute. So therefore you can fill out the tree and see whether the option will be called or not. And note that option adjusted spread is more sensitive than Z spread, which is basically just what happens to an instrument if you shift the whole curve by a basis point. It doesn't tell you much about the optionality. Just to mention some other things, a put option is usually long, so you can lock in a price even if the bond starts trading as a discount. And then there are amortizing ones, which are like a mortgage. The converts are probably the most interesting, and you might ask, sorry, I'll talk about, I think, converts more on the next slide, but some bonds have these unusual things like a poison put, so that if there's a corporate action like a takeover, then the bonds might be cashed in, require you to cash them in at par or even a premium to be punitive to someone who would want to take the company over. There could be a call and a put. There could be a simple ratings trigger and so on. To see these triggers and things, oftentimes you have to go to Bloomberg and look in the notes for the bond and make sure you do that right when you're pricing it. As far as the motivation for converts, it's essentially a situation where a company of poor credit, if it would go directly, first of all, a loan would be expensive at a bank. So it would like to issue a bond, but the fixed rate coupon that it would have to pay would probably be pretty high because of poor credit. So think like, a tech company which has a lot of sales, but no profit yet, like Amazon in its early days, and no collateral. So what you do instead is you issue it with a smaller coupon corresponding to maybe AA or AAA, but then you give the bondholder the right to convert it to a stock at a future date. This is one of the most difficult problems in mathematical finance because they're basically three stochastic processes, right? Certainly the stock is a process, the bond is a process, but then there's also a credit aspect. The issuer of the convertible might default. There's even a way that some of these can be forced to convert. All right, so just to talk a little bit about ancillary data, and then I want to make sure I have a little time. I see it's getting close to 9:42 here in New York to go through some of the SR 11.7 points. So a call schedule is just dates and call prices. They're typically called at a premium. So again, that would mean that, rates go low. Right, and you can do the same with sinking schedules, coupon schedules, and so on. Another point is that a lot of times a junior financial engineer may be just taught that you price all instruments as though they're starting today, spot start. Whereas in general, the instruments that you may be needing to compare to are market instruments that have been out there for a few years. For a fixed income instrument, payments in the distant past don't matter, but the most recent coupon payment and rate are important. Coupon date and rate are important because, as we said, part of that may be in the computation of the dirty price. So you need to have that last one. CACs, I think, are just worth mentioning because, particularly for stocks, even the ticker could change. And then if you're trying to do something back 5 years, you can't really figure out what it was. The CACs are kind of manual. In Bloomberg, I know there's a special function called CACs. It just stands for corporate actions. The cash dividend, just talked about the mechanics of that for a minute. So you might think that, well, the key issue is that if you're not actually holding the security, then the value of your, let's say, an option on a stock will go down on the date that the dividend is announced, which is called the ex-dividend date. Actually, the ex-dividend date specifically is after the announcement, but it's the first date that the underlying trades without. X is like extracurricular or extra dry, whatever. It's without the it's not with the dividend. The actual date of the payment isn't important. All the impacts felt on the X date. And that's because options don't collect dividends and so on. That's one of the reasons people like index options, because again, there are no lumpy dividends, so it's not going to do a jump down. Okay, so then talk a little bit about the fundamentals that you want to look for. One of these is this a model or a tool that I've been given? Even if it's been called a model, is it really just a tool? What other models does it depend on? Are those clearly spelled out? And that's important because, of course, if one of those changes and the model you're working on depends on on an upstream model, and that upstream model changes, then you have to be able to validate and use the freshest version and make sure that there's an understanding of that as part of the institutional knowledge. Another key issue is third-party dependencies, depending on numerics or murex or something like this. Even this question, can you actually build a challenge model, in R or Python or whatever? So questions to ask. And then there's 3 big topics. These are ongoing performance measurement or monitoring, benchmarking, and backtesting. So you can look at the developer setup and let's say if there's a prior model review document and see whether OPM was ever required or maybe was undertaken by the developer. And this is particularly important in new constructs like AI, where we know that there's drift in the models, that even changing one day of data can change the outcome of an AI model. So then you would want to make sure. So you say, okay, well, it's going to change, but I'm going to monitor by how much it changed. And then if it's outside, let's say a 2 sigma change, then I'm going to have to look more into it. It does add a layer of worry in that the monitoring has to be set up, it has to be performed, it has to be reported, and then someone has to decide whether there's an issue, a red flag produced by that. benchmarking is a little easier to understand. One of it is just, if this is version 2, then how does this compare to version 1? And can version 2 do all the things that version 1 could do? That's again, could be something like a limiting case, but a developer could perhaps do that for you. You could say, well, can you make this just do the functionality of 1 and make sure it ties out to version 1? Oftentimes the model may embed third-party software, but whether or not it does, it can also be benchmarked to a Bloomberg screen or to numerics, excuse me, and so on. And now back testing. So this is someone testing out or stretching their back. So first of all, not every model can submit to a back test. We discussed recently that PFE cannot be back tested, but VAR can. And VAR is kind of the usual thing we think of with back testing, even though there are other ones that can do. The idea is that is there a situation where you're under predicting a risk or a loss based on the knowledge known up to a certain date? And then you actually observe what happened, like a clean P&L. And so then you're under predicting a loss. That's called a break. So that's a bad thing. The model was less conservative than it needs to be. So for example, the Basel traffic light test will count the number of breaks. That's the simplest thing you can do, is in 250 trading days, how many breaks? For a given, 99%, say you expect 2.5 breaks of 250, so 2 to 3 breaks. So if you see 10 breaks, that's a problem, and that's when you'd get either a yellow or a red traffic light for VAR. I think 10 is red. But to do that back testing, first of all, you do need some infrastructure. You need product people who can impute the clean P&L for VAR. From a mathematical and stats standpoint, it's somewhat alarming that usually the only thing we do is count the breaks, because there are other properties of them. And I have reference, there's a guy, Christofferson, who is kind of an evangelist about this. The breaks should all be IID. So if there's clustering of these breaks, that's a problem. There should be no conditional breaks. In other words, the likelihood of a break tomorrow should have nothing to do with whether there's a break today. And if you have enough breaks, you can also look at its distribution. And again, that shouldn't show any structure. Right. So that is the material. The last 2 slides are on how to join and how to get in touch with me. I'm going to stop the share and open up for questions. See if I can get the YouTube window up too. Okay. All right. There's fine. I'm good. I think everybody's muted. Well, Radu is not, so it looks like. Is it Raris? How do you pronounce your first name? Is that right?
Yeah, Raresh is right.
Okay, Raresh. Okay, got it. Yeah, so it's not directly in the book, but it seemed to me that it's something that, what's the first thing you do kind of thing could be useful and could guide the way that you validate a model. And so that you're not 3 weeks into validating and you never check put call parity or something.
There is a significant difference there, because you validate model product combinations. So you don't really validate models. You validate the product you want to price with the price that you are using. So somehow that's why it explodes in terms of workload. Yeah. Because you don't have like, I'm local vol, stochastic, whatever. Now you have this on local vol, this on stochastic, this on that, and
Yeah, you can I mean in the what is it from the 1970s, the US movie The Paper Chase is about what it's like to go to Harvard Law School. And so there's sort of an infinite amount of, let's say that you have to review a case the next day, right? So you could look up all the cases that were referenced in that case, and then you could look at the second generation, all, and so in theory, there's an infinite amount of things you could look at. I'm just trying to, figure out the low-hanging fruit stuff. But right, local vol or, right. And skew. I didn't talk much. I talked about ways that you could observe the skew, but not like a quadratic model for skew or something like that, which is, something to do. And with regard to AI, also happy to talk for a few minutes about this AI in financial services conference I went to. It seems like the summary is that people use LLMs, but they can't explain the results, and that they're driven. Here we're talking about validating models, and we have some idea that there is a particular instrument, as you said, Radu, whereas in LLM, there's a particular use case, which may be far from, the skew of the S&P 500 or FTSE options or something. So that it's sort of like use cases in search of a model rather than a model itself. Yeah, when they said that they're mainly just thinking about text processing and things like that. So that I personally think the best use of AI at the moment within model risk management is just to do some of these things, like check that ongoing performance monitoring has happened, things like this. That doesn't really involve text, but it might, or it could replace, like now we have some sort of attestation process that, let's say the leads, the fixed income, equity, and so on, leads have to go to pages and pages of inventory and say, is this right? Have all these models been validated? Are there any ones that we've missed and things? That sounds like a much better task for a computer than for, death scrolling through 10,000 lines of Excel. But,
Yeah, I can think of a problem we had was this proliferation of scripts. So basically every new type of option had its own script for pricing. And then from time to time, you need to go through all this and say, okay, version 12 from this one, from autocallable version 12 covers all the others. And, you just need to set this and that. And because there was a scripting language only for, and most of the investment banks have scripting language
right.
for payoffs only. And then maybe managing these scripting scripts is more of a possible use case.
Yeah, and the other thing which first thought Morgan Stanley was valuation adjustments, VAs, that they would have, let's say, a Python option script, for instance, but then they would have an Excel spreadsheet, a tool, essentially to make the prices right. So what number do I have to add to the option price to offset something in the model that I don't understand to get the market price? And so it's not just maintaining the Python, but also maintaining all those Excel spreadsheets, which do whatever they do.
Yes.
Right. That's why earlier versions of this announcement had things. Yeah. I have a spreadsheet for that. Like, there's an app for that. There's a spreadsheet for that, whatever. Great. That doesn't give you a lot of confidence in model risk if everything is being done in spreadsheets.
I mean, there is the London whale thing.
Yep.
It's like a sort of
that's well, I worked up
thing. So.
That got me a job at JP Morgan. We were the cleanup. We did the cleanup after the London whale, after signing a legal consent order, JP Morgan with the OCC and the Fed. then spent years trying to figure out what went wrong. And one of them was what they called big pipes, which has, since there are no ladies on the call, that seemed to have some sort of sexual connotation to it. I don't know. But I guess it was like a big thing with lots of data going through it. And yet it was driven by a spreadsheet. And there were, you know, all these things, and they were part of the right calculations. Even someone like Pat Hagen, you know, the man behind Sabre, I think he was, if he wasn't the CRO of that group, he was senior in risk, and they were doing everything on spreadsheets. Yep. Okay, well, we're almost up at the top of the hour. If you folks have questions, again, I'll distribute the slides, or if you have a former talk, you'll see that my contact information's in there for follow-up, and you can also go back to now back to 12. 12 is the first MRMD that I did formally in PowerPoint. So there are, you know, nine of these that you can page back through. I didn't refer to any other ones here, but two recent ones in AI I've posted on. And if you have suggestions for a future talk or discussion, that would be helpful as well.
Okay.
Thanks, Jonathan. This was comprehensive.
Thank you. And thank you, Raj, for dropping
Thank you
in.
for the talk.
Yep. Have a good afternoon in Europe. Have a good rest of the morning in New York. Thanks.
Thank you. Bye.
Yeah, bye.